Gold is approaching a major liquidity zone where smart money is quietly preparing its next massive macro expansion. I'm focusing on a high-probability sell setup right above key liquidity today, but there's one specific, non-negotiable algorithmic condition that has to trigger before we even think about executing.
Most retail traders right now are aggressively buying into short-term momentum, totally unaware that a massive institutional trap is being engineered. So where are the major institutions actually aiming? Let's map the true targets, because this upcoming liquidity sweep dictates the entire setup.
Here's the outcome right up front. The daily macro bias for gold remains strictly bearish as long as we're below 41.15. The true institutional draw on liquidity, the macro sell-side target, is resting all the way down at 39.29. That's the magnet currently pulling price lower.
Keep this overarching framework in mind as we break this down. Our bias is bearish. The primary setup is a short, but only after a buy-side liquidity sweep. The trigger zone is exactly 40.76 to 41.15, and our macro targets are the sell-side pools resting between 4,000 and 39.29. You now have the exact parameters of the trade.
Let's zero in on this specific level, 47.66. This is the critical buy-side liquidity trap. It's exactly where retail buy stops are sitting. Smart money needs this precise liquidity pool to pair with their massive short orders. If you're buying a breakout here, you're the liquidity.
The macro narrative is crystal clear. Notice the steady series of lower highs and lower lows since the major peak. Institutional order flow is strictly bearish right now. The market is in a macro displacement phase, heavily drawn toward that multi-month sell-side liquidity sitting below 39.80. Smart money hasn't shifted this higher timeframe bias at all.
Now, dropping down to the H4 timeframe, we're simply observing a corrective retracement. Price delivered a strong displacement lower, and it's currently experiencing an internal recovery. It's moving back up into a premium array, specifically seeking unmitigated supply and fair value gaps left behind during the previous sell-off. This isn't a reversal, it's just a retracement to reload.
And here is where the trap is meticulously engineered. Price is drifting upward, deliberately creating relative equal highs near 40.76 to 40.85. Institutions are building a buy-side liquidity pool. By drawing price higher, they induce retail traders into believing a bullish reversal is happening. Once enough buy stops accumulate above those highs, smart money sweeps them to fill their massive short orders at a premium price. Here is the strict three-step execution sequence required for a high-probability entry. Step 1. Price must sweep the buy-side liquidity at 40.76 to 41.15. Step 2. We wait for a decisive M15 market structure shift down. And step 3, we enter strictly on the mitigation of the fresh M15 bearish fair value gap created by that shift.
Let's look at how this builds our confirmation trigger. If price sweeps 40.76, we don't just blindly sell. We have to wait for an aggressive displacement candle that breaks back down below 40.60, closing with strong bearish momentum. That break of structure is the literal footprint of smart money stepping in. Without that displacement, the setup is entirely invalid.
These are the strict institutional risk parameters you need to follow. The entry zone is 40.78 to 40.85, right inside the H1 bearish FVG. Stop loss goes strictly above 40.9250 to clear the invalidation level. We scale out at 40.50 for take profit 1 and target 40.23 for take profit 2. That yields a very clean 1 to 4.5 risk to reward. Every scenario is mapped out in advance. But here's the problem, and it's where most traders fail: patience. Right now, the only directive is to wait. There is absolutely no valid institutional confirmation yet. If that three-step sequence doesn't print exactly as outlined, there's no trade. If smart money hasn't shown its hand by displacing price lower after a sweep, we do not click the button. Discipline is what preserves capital.
The market is also telegraphing a serious warning signal through today's macro catalysts. We've got the US ISM Manufacturing PMI at 9 p.m., alongside geopolitical headlines about the US and Iran, OPEC Plus output hikes, and a weakening DXY. These are the exact narratives that will be weaponized to drive volatility.
This is exactly where most traders are going to get trapped. Retail traders are looking at the weakening dollar and those Middle East peace headlines, and they're emotionally buying early breakouts. The institutional reality is entirely different. Institutions are coldly using this news-driven retail buying pressure to engineer a buy-side liquidity sweep directly into H4 supply. They are literally selling into the retail buying frenzy. Which brings us to the Judas swing. This is a false price movement engineered by institutions, usually during high-impact news, to trigger stop losses before the real macro expansion happens. That 9 p.m. ISM Manufacturing PMI release is highly likely to act as this exact catalyst. Expect a rapid spike higher to sweep 4076, clear out the early sellers, trap the breakout buyers, and then reverse aggressively lower.
However, smart money might take an alternative path, and we have to be prepared for that. Our absolute invalidation level is an H1 candle body closure above 4095. If price sustains a close above that level, the bearish market structure is broken. The supply arrays are invalidated, and this specific sell setup is completely canceled. We respect our risk parameters strictly.
Let's quickly lock in this narrative. The daily and H4 bias is firmly bearish. Our primary trigger is a sweep of the 4076 buy-side liquidity pool. We only execute on an M15 market structure shift and fair value gap mitigation. Our macro targets are the 4,000 and 39.29 sell-side liquidity levels, and most importantly, risk is capped at a maximum of 0.5% to 1.0% per trade.
So the final question remains. Will you fall for the emotional retail trap during tonight's news, or will you patiently wait to trade the cold, calculated institutional order flow? If you found this explainer of institutional market analysis helpful, make sure to subscribe to ICT Market Theory. And if you want to execute these exact setups alongside us, you can find the FXTM account link pinned in the comments below. Stay disciplined, wait for confirmation, don't become the liquidity.